Have you thought of why share prices are fluctuating continuously from the opening to the closing of the day? Do you want to understand what are some of the factors which affect the share prices? Also, towards the end, I will tell you a strategy that helps you to pick a stock like an expert even if you are new to markets. Watch the video till the end. Hi everyone, welcome to FinBites. I wish you all a very happy Ram Navami. Let's get into today's video. Why stock price fluctuates continuously. The main reason for the fluctuations in stock prices is supply and demand at that given point in time. Most of the business's economic concepts works on the principle of supply and demand. Let us consider an example. Imagine you are in a beautiful art exhibition. There is a rarest painting of Leonardo da Vinci which comes to an auction. So at that point, we have a supply of just one painting. But since it's the rarest, almost everyone in the exhibition wants to buy it. So the demand for purchasing that painting is high and people will be ready to buy at higher prices also. Hence, when supply is limited, demand will be more, which increases the price. Similarly, we have another painting that has multiple replicas, and no matter how many people ask for it, they can produce or print it accordingly. In this case, supply is high. When there is something more common and adequate, people won't be interested in paying high prices, or the craze for that particular item won't be much. Hence, demand for that would be less and prices will be reasonable or at a discount if we are good at bargaining. Using this principle, most of our day-to-day things such as vegetables, pulses, real estate and stocks are priced. In stock markets, if many people decide to sell a particular share, the supply for that share is more. And if there are only a few buyers, the sellers would be ready to offer that share at a discounted price for those buyers. On a contrary view, if many people are willing to buy a particular share, then the demand for that share is more. And if there are only a few sellers, the buyers would be ready to offer higher prices for that share to buy from the sellers. This is the reason why share price fluctuates. It's because of supply and demand. Let's also understand why do supply and demand of any particular stock changes. The reason is due to information or news related to that particular stock. The way these news are interpreted by investors and traders results in change in supply and demand. To understand this, let us consider a scenario. We have a piece of information on a listed company that it has received a huge order of worth 1500 crores. Because of this news, there might be high demand for the stock and hence stock price shoots up. But in the course of time, if the same company doesn't fulfill the order criteria or the terms and conditions of the projects are not met, then the demand for this stock might go down on an anticipation of cancelling those orders or losses incurred due to taking up of this order. Hence, in this case, people try to sell the shares and price starts to decline. You will get loads of information through news, social media and many other sources. But the most important point is, you should develop the skill of analyzing the information and make a decision accordingly. To process the information, many people may follow some of the factors which we will be discussing in the next section. I personally combine multiple factors which gives a better probability to pick a good stock. Factors or methodology to process the information are: Number 1. Fundamental analysis. This methodology is most commonly used by investors. They have a long-term view of the company they are intended to buy and keep following the company's quarterly results, performance and take a decision accordingly. We should start analyzing if company is making profits or losses. If they are making losses, we should check if the loss is due to some short-term crisis or will it continue longer. Is the top-level management of the company is good or not? Integrity and trust factor of the management should be checked. Our debt levels of the company is good. Growth prospects, long-term vision and many more needs to be analyzed in fundamental analysis. Usually, when quarterly results are good, people start to buy those stocks and the demand for those stocks will have high momentum. This short-term momentum advantage is mostly used by traders to make profits. Fundamental analysis on its own is a very huge topic to study. Once we complete our basics of stock market theories, if enough interest prevails, we will make detailed videos on concepts of fundamental analysis also. So stay tuned with us through Instagram, Facebook, and subscribe to our YouTube channel. Number 2. Technicals. This methodology is most commonly used by traders. They usually open up charts and check out for key supply and demand zones, which are nothing but support and resistance. Also, traders usually prefer high volume and high liquidity stocks. The reason being, if there is any positive news in the short term, the shares are commonly known to public, and the demand for that share will increase quickly and vice versa. So these traders can take advantage of such moves within a short period and make money accordingly. Based on some of the parameters such as candlestick patterns, technical indicators, chart patterns, they decide their entry and exit position from the stock. Number 3. Macro and microeconomic factors. This factor takes into consideration of politics, natural disasters, geography of a specific country, relationship with global countries, and many more. Let's consider an example. India is a net importer of crude oil. Due to tensions in Russia-Ukraine, the prices of crude oil have been on a rise. The reason for the increase in crude oil is Russia is one of the major producers of crude oil, and due to the war, most produced oil are used by themselves or released lesser to the other parts of the world due to supply chain restrictions. This creates a shortage on the supply side and on the other hand increases crude oil demand. Due to this mismatch, oil price increases. Some of our listed companies use oil as raw materials, and in such cases, there will be impact on the profit margins of those companies. Due to this chain reaction, the share price of the companies using crude oil as raw materials would have fallen. So, this is how each and every event in some other part of the world will affect our markets also. Events such as elections, natural calamities, trade policies, monetary policies, fiscal policies, and many more need to be taken into consideration. We should always try to analyze global and domestic events so that we will get an idea of which commodity, product, or company will have higher demand. If you want to learn many such concepts and keep yourself updated with market news, check our YouTube Shorts section. Here we will be posting one financial term of the day which covers the explanation of that concept in under a minute. Subscribe to our channel for more such updates. Number 4. Human sentiments. This is one of the most crucial factors. Even though we are very good at analyzing and processing the information, ultimately it's our psychology or emotions which drive prices in the stock market. If the overall market has a positive notion, then the market starts to grow. And if the overall market has a negative notion, market starts to fall. It is always advisable in stock markets we make decisions based on facts rather than human emotions. Fear and greed are the two major human emotions that leads to more losses in our stock market journey. By now, you would have understood how the demand and supply of a particular stock changes. Finally, as promised, I will teach you a very simple strategy to pick a stock like an expert. Even most of the ace investors like Warren Buffett, Charlie Munger, Rakesh Jhunjhunwala, and many more follow this strategy. The strategy is very simple. Keep buying the businesses which you understand and you use daily. Disclaimer: the stock picks mentioned below are for educational purpose only. Please understand the risks involved in capital markets and do your due diligence before investing. Let's check an example. We might have been eating Maggi since our childhood. In that case, check the charts of Nestle and you will understand how much returns it has delivered to its shareholders. Going forward, we still love Maggi and continue to eat Maggi. In that case, we can invest in Nestle in a SIP mode, which helps us in achieving rupee cost averaging. To understand what is rupee cost averaging, check the video in the I button. Similarly, there are many successful businesses that we use in our daily life, such as HDFC Bank, ICICI Bank, Hindustan Unilever, Dabur, Marico, Bajaj Finance, Reliance, Hero MotoCorp, and the list goes so on. So investing consistently over a longer period of time will yield us good returns on our portfolio. I hope you enjoyed the video. If you have any questions, comment below or drop a message through Instagram or Facebook. Like and share this video with your friends and your family members to enhance the knowledge and power of investing. Thank you. Bye.